Let me ask you a question. How many times have you identified the perfect direction for a trade? You know it's bullish. Everything screams bullish. The higher time frame structure, the narrative, the bias, it's all there. You see a breakout, you buy, and almost instantly the market reverses against you. It hits your stop loss, it takes your money. And then, just to add insult to injury, what does it do? It reverses again and flies toward your original target without you. You sit there staring at the screen, feeling like the market is personally attacking you, like the algorithm knows exactly where your stop loss was. Here's the hard truth. It wasn't bad luck. It wasn't a coincidence. It was an engineered cycle. You were caught in the manipulation phase of the power of three. You were the liquidity that the smart money needed to fuel the real move. Today, we are going to fix that. We are breaking down the ICT Power of three: accumulation, manipulation, and distribution. We are going to turn you from the victim of the trap into the predator who waits for it. Welcome back to the podcast. Before we begin, a quick reminder. I am not a financial advisor. This is not financial advice. We are here to talk about the psychology of trading and reading price action with professional discipline. Let's get into the charts. Let me tell you a story about a trader named David. David is a breakout trader. He sees a consolidation range forming during the Asian session. He's been told by retail books that consolidation means the market is building energy for a breakout. He stares at the charts at 2 a.m. or 3 a.m. New York time. Suddenly, price aggressively breaks below the support of that consolidation. David thinks, this is it. The floor is broken. We are going bearish. He sells. He puts his stop loss just back inside the range. He feels good. He feels proactive. He's executing. But David doesn't understand dealing ranges. He doesn't understand time. 10 minutes later, that drop stops on a dime. It wicks. It reverses. It screams back up through the range, taking his stop, and continues to rally for the rest of the London session. David just sold the low of the day. Why? Because he traded the manipulation. He provided the sell-side liquidity for the smart money to buy. If you want to survive in this game, you have to stop thinking like David. You have to understand the anatomy of a candle. The power of three, or AMD, accumulation, manipulation, distribution, is the narrative of how price moves from point A to point B. Think about a daily candle. If it's a bullish day, what does it usually look like? It opens, it drops down first to create a low wick, it rises up to create the body and the high, and then it closes. Open, low, high, close. That drop below the opening price, that is the manipulation. That is the Judas swing. That is where the algorithm traps the sellers to fuel the buy orders. If you're buying at the open, or worse, selling the breakdown below the open on a bullish day, you are ignoring the fundamental law of efficiency. Let's break down the three phases. First, accumulation. This usually happens during dead hours or the Asian session. Price moves sideways. It's choppy. It's boring. Why? Because the algorithm is building positions on both sides. It is inducing traders to put stop losses above the highs and below the lows. It is building a pool of liquidity. Lesson number 1 regarding accumulation. Do not trade it. Pause. I will repeat that. Do not trade the accumulation. If the market is moving sideways in a tight range, your edge is 0. You are gambling on noise. Patience is not just waiting for a setup. Patience is waiting for the accumulation to finish. Next comes the manipulation. This is the killer. This usually happens right at a kill zone open. Maybe London open, 2 to 3 a.m. Y, or New York open, 8:30 to 9:30 a.m. NY. The price makes a sudden, aggressive move away from the true intended direction. If the bias is bullish, price will aggressively drop below the accumulation lows. This serves two purposes. 1, it stops out the early buyers who had their stops below the lows. 2, it tricks breakout traders into selling short. This sudden flood of sell orders provides the liquidity the algorithm needs to buy huge positions without slipping the price. They are buying your fear. And finally, distribution. Once the liquidity is taken and the smart money is positioned, the price expands rapidly toward the real draw on liquidity. This is the easy move. This is where you want to be involved. But you can only catch the distribution if you survived the manipulation. So how do we fix your trading process using this? It starts with the opening price. Midnight New York time, 8:30 a.m. New York time. These are your anchors. If you are bullish for the day, you generally want to buy below the opening price. You want to buy when the price looks cheap or at a discount. If price is above the midnight open and you're bullish, you're paying a premium. You're chasing. But if you wait, if you let the price drop below the midnight open, you are now in the territory of the manipulation. This is where you stalk your setup. I want to take you through a short visualization. Close your eyes for a moment if you can. Imagine you are sitting at your desk. It is 8:25 a.m. You have marked the midnight open price on your chart. Your bias is bullish. You see the 8:30 news release hit. The candle violently drops red. It smashes through the lows of the last hour. Your heart rate spikes. The retail trader in your brain screams, "It's crashing! Sell!" But you do nothing. You breathe. You watch the price dip into a higher time frame point of interest. You watch it purge the liquidity. You are calm because you expected this. You know this is the Judas swing. Then you see the shift, the candles stall, a displacement back up, a fair value gap forms. Now you strike. You enter as the price returns to efficiency, knowing that the trap has already been sprung. You are safe because you waited. Open your eyes. That feeling of control, that comes from understanding the power of 3. It shifts you from guessing to anticipating. You aren't reacting to red or green candles. You are reacting to where price is relative to the open and the liquidity. This brings us to the concept of time and price. The manipulation phase isn't random, it is timed. If you see a massive move happening at 11 a.m. when the market should be slowing down, be skeptical. But if you see that manipulation at 9:30 a.m. or 10 a.m., that is the script playing out. Time validates price. Many of you are losing because you are trying to catch the very bottom of the manipulation. You are trying to catch a falling knife. Don't do that. Wait for the hand of the smart money to show itself. Let them raid the lows. Let them show displacement back in your direction. Then, use the PD arrays, the order blocks, the FVGs to get in. Here is your reset protocol for the next session. This is how you implement AMD into your daily routine. Step 1. When you sit down, identify the accumulation. Where has price been ranging? Mark the highs and lows of that range. Step 2. Mark the opening price, midnight or 8:30 a.m. Draw a horizontal line. This is your line in the sand. Step 3. Define your bias. Are we likely expanding higher or lower today based on the daily chart? Step 4. The wait. If you are bullish, you sit on your hands until price trades below that opening price and takes out the accumulation low. You do not touch the buy button until that happens. If it never happens, you don't trade. You protect your capital. Trading is not about frequency. It is about quality execution. The power of 3 is the blueprint of quality. It ensures you are buying wholesale and selling retail. I want to leave you with a challenge for tomorrow. Open your chart, go back to the last 5 days, put a vertical line at midnight New York time. I want you to identify the AMD cycle in each day. Find the accumulation, find the manipulation, the fake move, find the distribution. Notice how often the high or low of the day is formed during a kill zone, right after a manipulation of the opening price. Train your eyes to see the trap before you step into it. Once you see it, you cannot unsee it. Stop chasing the candles. Let the market come to you. Let the algorithm do its work. Let the impatient traders lose their money, and then, and only then, do you step in. Stay disciplined. Stay focused. I'll see you in the next episode.